Okay, so let's proceed. All right, so we are going to pick our position tool. This is where to look for your position tool, and we're looking for the long position tool. We click on it, and then we'll put it at the close of our close above candlestick. Now, what is the next thing for us to do? We've satisfied our conditions. We've satisfied our entry. What's the next thing for us to do?
Stop loss.
Stop loss. God bless you. We have to look for our stop loss. And how do we look for our stop loss? We are going to drag our red box, the red box being the bottom of the position tool. We are going to drag it to meet our termination zone. Okay, I want to zoom in so that you see it again. Now, this same process applies to the double top. It's just the inverse version. They're just doing the opposite of what we're doing here. That's just all. There's no difference at all whatsoever. So we have dragged it to our termination zone. Now, what is the next thing for us to do after doing that to get our actual stop loss? What's the next thing for us to do?
We have to add the two numbers together.
Which number and which number? You tried, you really tried for that. But which number and which number are we adding?
The ATR indicator.
The ATR indicator and the number we're seeing on the stop loss. In fact, I feel like giving all of you pounded yam. You're really impressing me. Thank you very much. So thank you. You've tried. At least my efforts are not wasted. So, and the number, we're going to use the ATR indicator of our entry candle, right? So we're going to shift this to the side, and our entry candle is this close above. Our ATR here, our ATR indicator is showing us 0.00089. So what do we do with that ATR indicator? We disregard the last number because the last number is not a pip, it's a wick. So we're just calculating 0.008 plus 0.0009, and that gives us what? It gives us 0.0017. So we're going to drag this down. We're going to drag this, our stop loss, down till we see 0.0017, and there we have it. We have 0.0017.
Okay.
So the next thing for us to do after we have that 0.0017 is to now look for what? That means that we've gotten our stop loss, right? Let me put a line there.
Yes.
Let me put a line there. And our stop loss is at 0.10712, right? That's our stop loss. Now, our take profits, we've already satisfied what now? We satisfied conditions, right? We got our termination zone. We confirmed it was a double bottom. By those conditions we explained, we ensured that price was around 30 on the RSI indicator, and our RSI indicator is on what length? Is on length 10. And then we got our entry by looking for an entry candlestick, which is a close above. We then got our stop loss by keeping in line with the volatility of this trading pair using the ATR indicator in addition to where our termination zone ends, right? And then what did we then do? We've completed the conditions and the entry, and we've also completed the stop loss because we added the ATR to where we saw our stop loss at the termination zone. Now, the next thing for us is to do what? We're following CEST. We've done conditions, entry, and stops. What's the next thing for us to do?
Target.
Our target. God bless you. God bless you. Our target. So our target now is what I said that for this particular trading pair on the 1 hour time frame, from my back test results, we have a 1.4 likelihood most times and a 70 to 30% winning ratio. So that means out of 100 trades, 70% of the time, this is going to give you a win. Okay, if you trade this. So now we're going to increase it and have what we're going to pull our green box to where we till we get our 1.4, which is sorry, till we get our 1.4, which is around here. Okay, so we have our 1.4, and as you can see, price actually touched that point, right? Because price even went above it. So this was clearly a winning trade. And trust me, these two patterns, the double bottom, the double top, are very, very, I can't overemphasize it. They are very, very profitable trade strategies once you follow the guidelines I gave you. The first thing, ensure you're seeing your double bottom in an area of structure. That means you're seeing it at a key market level. The second thing is you want to draw your termination zone. After you've drawn your termination zone, the third thing is you want to confirm the validity of that double bottom by ensuring that you don't have a bodies that closes below that termination zone, and ensuring that you have a wick that at least touches that termination zone. The next thing is to also ensure that you have your RSI around that 30 area, which shows that buyers are likely to start coming in and the trend is likely to reverse. After that, we pick our entry reason, which is a close above candlestick pattern. Then after that, we pick our stop loss using the ATR indicator by adding it to the figure we get on the stops bar when we draw it. When we draw this red box to our termination zone, we then pull it to whatever addition we get. From that point, then we then draw our green box to hit 1.4 reward to risk ratio, and then we keep those numbers in our head and go to our exchange to place those trades. Now, how to place trades on futures in an exchange is what today is all about. So since we've revised this, we're going to go to futures for you to know how to place these trades. And then after that, I said I'm going to give an additional training today. So let's just make sure we finish the training for today. Already we have 2 very good trade patterns that you can even start using right away to start profiting enormously from the market. I told you I traded this today. In fact, let me show you what I traded today so that you can see it. So it won't be like I'm just coming up with crap. Okay. Now, what I did was to trade. You can see I drew several markets, several key market levels here, and I traded this particular double bottom, this one. What I did was then, because I knew that this was going to retrace because we are forming a head and shoulders pattern, right? We talked about head and shoulders pattern. This is one head here. This is one shoulder here. This is one head. This is another shoulder forming here. So I knew that we were still going to go back to this point. So that is the reason why I increased my leverage and took my profits at the neckline. Now, again, I have re-entered this trade because I know that price is still going to drop back to this point. So I'm still going to make another 100% profit probably by 12 a.m. thereabouts today again. Then I'm going to re-enter it again at the break of the neckline. And that is how to trade basically a head and shoulders pattern. But we'll also discuss this probably on the 7th when we have more time to discuss some additional trade patterns if we don't have too much questions to battle with on that day. So this is the trade I did today that gave me that $100 profit. You can see I used the Fibonacci to also know some of my targets, but it's not really compulsory. I seldom use it. I wanted to know the point in which this neckline was going to retrace. That was why I used it. But let's just continue with what we're doing. I just want to show you that double tops and double bottoms also work. If you look at this is also a valid double top, right? This is also a valid double top because we saw price pushing down from here, touching the resistance zone. going to the neckline, going back up again, then finally pushing down and creating a lower low than what we had in the neckline before we then saw a retracement upwards to create the head pattern. So this is a valid head and shoulders pattern. And what this means is that this price, if it gets to the neckline, this line I drew right here is where we have our neckline. Let me bold that for you. Okay, so this area here is where we have our neckline. Okay, we have it from that area to where the wick has touched, which is somewhere around here. So I'm going to reduce the size of this one. So from here to here is our neckline, which tells us that once price drops and breaks or closes below this neckline, the way we're going to take targets for this head and shoulder pattern will be to draw a trend line from the top of this head to where we have the neckline, which is around here. And once we've confirmed a candle closing below that neckline, we then move this. I'm already giving you this bonus on how to trade the head and shoulder pattern. I hope you are jotting. We then move this to this point. You can see that this line was already there because I already used it to get my target. And that is how you get the target for trading a head and shoulder pattern. Okay, so you know that if price should close below this neckline, it's most likely going to drop to the next support zone, which I drew here, gotten from a higher time frame, and this is at 0.0836. So the first thing I did was to go to the daily time frame, pick my key market level support zones, and then what I then did was to drop to a lower time frame, which is the 1 hour time frame, look for signs of double top, head and shoulder pattern, and then I picked my trades and I made profit. So that's basically how to trade the head and shoulders pattern. Now, for us to continue, I just wanted to show you that this double bottom actually worked. This also worked. I just didn't trade this. My people traded this when I gave them the analysis. I couldn't trade this because I was very busy that day and I couldn't be monitoring the trade, so I just abandoned it. My people traded it. Someone made up to 292% on that particular trade, and it was a double top. Okay, this one as well. So people made profits from it. It was a double top. So double tops give profits. You just need to master the conditions I've told you, because that is how I trade it. That's how I traded today's zone. That's how I trade it, and that's how I make profits from it. So by now, you should be able to start making profits on your own if you start trading. So with that being said, let's go to the Binance exchange, because now we're going to use what we've learned here. We're going to use what we've learned here to showcase how you have to enter these trades into an exchange, because like I said, we're going to be using TradingView just for chatting purposes. That means we're chatting the market, but we're going to be placing the trades on a broker, that is on an exchange. So like I said, we just use TradingView for chatting because it gives us the most accurate price action movements and prices, but we're going to be executing the trades on an exchange, and we have different types of cryptocurrency exchanges. We have Binance, we have Mexi, we have Kraken, we have KuCoin, we have OKEx, we have Bybit, we have Bitflex, we have Bittrex, we have several hundreds, thousands, of cryptocurrency exchanges. So pick the one that best suits you, or that you feel is most accurate in prices, or suits your trading style. I personally use Mexi, and I also use Binance. I just stopped using Binance a little bit recently because they had a lot of controversies, but it's a very good exchange as well. People are still using it. You don't need to follow me hook, line, and sinker. Find what works for you. So for today's training, we're going to be using Binance. And once you log in on Binance, this is what you're going to see. Okay, you are going to see your dashboard, or however, your homepage, or however you want to call it. You would see a place for markets, you see trade, you see derivatives, you see finance, you see more. Now, you want to place a trade. You've chatted on TradingView. What's the next thing for you to do? You want to place a trade, right? How then do you place this trade? we are going to be trading on futures because I explained futures, although it's a fast-paced market, it allows us to trade using leverage. That means you can trade with much more capital than you have with you to be able to make much more profits. The trade I entered today, I entered with a 20x leverage. That was 20 times the capital I used to place that trade. So using futures gives you that kind of ability. So even if you don't have much funds, you can use futures to make more profits. But because you're making more profits, you also have the room to make much more losses as well. Now, to trade futures, what do? We go to the derivative aspect. Now, I want to explain what this means to you. Okay. When you click on derivatives, you see basically everything you're saying here is futures, 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 right? Because derivatives refers to futures, okay, in the crypto space. Now, you can see that we have two different types of futures that we're seeing here. You are seeing USDS futures, perpetuals contracts. You are seeing coin M futures, perpetuals contracts. Now I want to explain the difference between these two. When you're trading, I want us to look at something. Let us go back here. What do we have on the screen? We have GRT USDT. That means you are trading GRT, a cryptocurrency, against USDT. Are we following?
Yeah.
We are trading GRT, a token, against USDT. Now, let's go back to this place. We are on derivatives. We're explaining this. This tells us, this USDS futures tells us that we are trading that pair against USDT. This coin M futures tells us that we are trading that pair against another coin. So let's say we were trading GRT against Bitcoin. That is when we will open this particular futures derivative section. But we are trading GRT against the USDT, which is the digitized form of the US dollar. We are trading it against the USDT. So we are going to be using the USD futures derivative section. And so we're just simply going to click on it. For most of my trades, in fact, I've never used this for any futures trade. Never. I always trade against the USDT because cryptocurrency is very volatile. Trading a pair against USDT is volatile on its own. Talk less of trading a cryptocurrency against another cryptocurrency, like too volatile. I mean, come on. So I do not even go there. Mr. David is laughing. I do not even go there at all. I don't want to have headache and I don't want to have high blood pressure. I like to sleep and rest sometimes. So I just trade against the USDT. So we're going to wait for it to load. And while it's loading, I want to explain some of the things you're seeing on the screen and how to utilize them. Now, like I said, I told you that TradingView has a paid version and that you might not see some time frames on it, or if you do not upgrade your subscription. But I told you that if you needed those time frames, you can go to the exchange in which you're placing those trades to place to look for the time frames or any other additional features you might need that is not on the free version of TradingView. Okay. And if you feel like you don't have time for all this, you can just upgrade your TradingView account and pay for their service or whatsoever so that you can actually make profits from that. So from having all the features that you want. I personally, since I've been trading, I've never paid for TradingView. So it's your discretion. Some people cannot trade without using some features. So you know, I just like to put that out there. Now, on TradingView, like I said, you won't see anything like the 12-hour time frame or something. But if you click here, you would see much more time frames. Okay, you can see the 12-hour here, you can see the 8-hour here, you can see the 6-hour here, you can see a lot more time frames. You can see 1 week, 1 month, 3 days, some that you won't see on TradingView. So you can click on the time frame you want, and then the view is going to actually change and show you. Now, the funny thing is that this particular view on the web version is still TradingView. So you're like getting the paid version free by using it on your exchange. So There are just ways to cut corners around these things. That's why I just don't bother myself paying for some unnecessary things. Now, I'm explaining this whole exchange to you, the whole dashboard. Now you're on the future section, but this is showing us BTC against USDT, and our trading chart is on GRT against USDT. So the first thing we need to do is to look for the pair we are trading. Okay, so we're going to type on the search bar and click on GRT. Now we have it here, GRT USDT perpetuals contract. So we're going to click on it. And then it's going to load the GRT USDT perpetuals contract chart for us. Now we want to place a trade, right? We want to place a trade. What do we then do? There are different ways to place a trade. We have the limit order, we have the market order, and we have the stop limit. Now I want to explain what each of these does. I'm going to ask us these questions again tomorrow. And please, since you impressed me today, please kindly jot so that you can revise. And tomorrow, my head can swell when I ask you a question and you're able to respond properly. So please kindly
You
jot
didn't
all
give
these
us
things.
pounded yarn today.
Don't worry, the pounded yam, they are still pounding it. When they finish pounding it, I'll share it. Don't worry. Okay, so let's continue. As I was saying, the limit order simply means that you're placing a trade at a particular entry point. Now let us go back to our GRT USDT here. Our entry here is at what? 0.10873. Let me draw the line there so it will be clearer for you to understand. Okay, our entry is here. And our stop loss is at what? At 0.10722. And our take profit is at 0.11142. So we have those numbers. Now we then go to our Binance or whatever exchange it is you're trading. Okay. Now I don't know, for some that are observant, before I even continue, for some that are observant, I want to call your attention to something. This trade, we are trading it on what? We click the Bybit exchange here, right? This is the Bybit on TradingView. You would always see the exchange here. If it's Binance, it will show here. If it's Mexi, it will show here. So this trading chart is actually trading chart for Bybit, but we are trading on Binance. Have we done what is correct? No. We're only just using this for the purpose of explanation. Whatever exchange, I think I said this before we even started our practical classes, whatever exchange you're trading on is the exchange you're going to click on. I did not click on Binance because on this pair, I've done a lot of back tests and it will be perfect for us to use it for our back test tutorial. That is why I didn't click on the Binance one. Are we following? So now, why is it important for you to use the exchange in which you're trading? Just look at this right now. The price of GRT on Binance is at 0.10071, right?
Yeah.
The price of GRT on Bybit is at what? 0.10083.
That's arbitraging business, another business.
So you can see that there's a difference in the prices. So if you pick the wrong exchange to chart and you go and enter all these inputs here, you are going to be making a grave error. And you might actually even lose that trade if care is not taken, because the prices are moving differently. Okay, so always put in mind, once you just open TradingView like this, bam, the first thing you are going to do, search for the trading pair you want in line with the exchange in which you're going to be placing that trade. I cannot overemphasize that. It's very important, please. Now let's move forward. We were discussing the limit order. Now, the limit order is what made me remember to reenact that. If you want to place a limit order means that, let's say the price has not gotten to where your entry is. Our entry is at 0.10883. 10870. Price hasn't gotten there yet. So we use a limit order. Okay. Let's say we're trading a pair in which, excuse me, let's say we're trading a pair in which we want to scalp, and then we want to be waiting only at the support zone. If price is above, I mean, we definitely will not want to enter that trade. But maybe you want to quickly do something, or because of the volatility, you want to quickly set that trade and maybe go out or something. You can then put a limit order that once this price drops to this point, I want you to enter the trade. Do we get it now? That is the purpose of a limit order. A limit order is set when the price of an asset has not gotten to your entry price. So it's like sending somebody on an errand. Once this price gets to this place, enter the trade. So that's the meaning of a limit order. So now we have the second one here, market order. The market order is like, okay, I want to place this trade, and you are saying that the entry is at 0.1087 something, but you can see that the entry is already increasing, and you don't want to miss out on that trade. So even if your entry is below the present price, because you don't want to miss out on that trade, you just enter straight up without telling it that, okay, wait for me, or let it drop before I enter. If you are saying, okay, wait, let it drop before I enter, or whatsoever, that is a limit order. But if you just see that, oh, this price is already around my entry point and I don't want to miss it, you just want to enter straight up, then you use a market order. Are we
Can we
following?
say like yes? Can we use this in another term like entering in a hurry?
Yes, it's more like entering in a hurry. You
Okay.
understand? It's more like entering in a hurry. But sometimes you might find out that it might be exactly on your entry price. So if it's exactly your entry price, you're not entering in a hurry, you're just entering in your entry price. Do you understand? But most times I tend
Yes.
to use limit order, because before you see market actually in your entry price, it take a while. It's very few times that will happen. You understand? So, but most times you would see that a lot of people tend to use this oh, sorry, I clicked on the wrong one. They tend to use the market order and also the limit order. So people tend to use the market order. Let's say it's close to their entry point. Then the limit order, if they want price to hit a point before they enter the trade. Now, this limit order, whether you are entering in a hurry or not, if you are trading futures, you need to understand that you're going to use limit order a lot, because they are going to be DCAing into your trades. Okay, you're going to have to DCA into your trades, and I'm going to explain that in a minute. But let's just explain how to even place the futures trades. Now, the stop limit refers to your stop loss. Okay, the stop limit refers to your stop loss, where you are putting your stop loss. So you have to look for where your stop loss is on your chart, and then come here to impute it. So let's say, for example, I want to place a limit order. I don't think I have money on this Binance though, because I can't remember the last time I used it. I use Mexi most times, but I want us to use this one to explain, because it's exactly the same thing. And this is actually, it responds faster on web than Mexi. Mexi kind of lags sometimes on the web. So I don't want the class to be frustrating. That's why I said let's just use Binance to explain. Now, the limit order is what we want to use. So we want to enter at what price now? We want to enter at, what is our entry price? Our entry price is at 0.10864. So the first thing for us to do is to click on limits, because we want it to enter at our entry price. We're entering 0.64. Am I correct? but that's it, yeah. Then yeah, it's going to tell us to input our size. How much are we going to put in this trade? So I can put $100. I don't know what just happened. Sorry about that. I can then put $100, which will equal to 920 GRT, which is what I'm going to be trading. I can then put $100 and say I want to trade with $100. Then here I can adjust my leverage. Okay. This particular one can be used to adjust your leverage. This doesn't actually adjust your actual X. That means if you are using 2X or 3X or whatever. This one, actually, what it does is that it tells you the percentage of your capital. So I can adjust it to use 25% of my capital, or use 45%, or use 19%. But I most times don't use that. I just enter the price I want to put, which is $100. Okay. So now after that, we're now going to enter in this exchange, whether we are entering a long or short position. We are entering a long position. Am I correct?
Yeah, if the price is going up, we enter long.
Okay, so our present trade is a long trade. So we are entering a long position. Now our take profits, we can enter our take profit here, and our take profit is at what? Please, I hope you are following me and doing the same thing on Binance, because the more you do it, the more it sticks. Our take profit is at 0.11130. 0.11130. That's where our take profit is. And our stop loss is at where? Let's go back. Our stop loss is at 0.10710. So we're going to enter it 0.10710. Okay, so this is actually because I do not have capital on this particular exchange. This is what happens is that this would normally calculate your estimated PNL. PNL refers to profit and loss. It's short form for profit and loss. It'll tell you how much profits you're most likely to make on that trade and how much loss you're most likely to make on that trade. Now, excuse me, you can see here it is writing available. My available balance here is 0.00 USDT because Mr. David did not send me money that I can put in this exchange. So that's why I don't have any money in this exchange. Please tell Mr. David to send me $1,000 so that I can put in this exchange, so that at least there'll be money. Okay, let's continue. So the next thing for us to do is to Mr. David will not talk like that. The next thing for us to do. You cannot hear Abby. The next thing for us to do would then be, since this is not showing, you can as well use the calculator to, whether it's showing or not, you can use the calculator to calculate what your profit is going to be like. And you can see I'm clicking on that calculator icon. Okay, let me click on it again so that you get what I'm saying. This is our calculator tool here. I'm clicking on it. So now, how to use this calculator tool? When you click on this calculator tool, you can adjust your leverage. Okay, you can adjust your leverage. You can say you want to enter with just 5x. That means that if you have $100 in this exchange, the position is going to open for you is $500. Now, if we put an entry price here, if we put all our entry price and exit price, and as well as If we put our entry price, exit price, as well as the quantity, it is going to give us our estimated P&L here. Are we following?
Yeah.
Yes.
Okay. So you can adjust your leverage here, and also it can show you your liquidation price as well. I was trying to say that when you're trading futures, you have a tendency to get liquidated. That means your own money might get burnt if you don't use stop loss order. Are we following? If you don't use stop loss order, you might lose all your money.
Yes.
Unlike spot trades where you can't lose all your money, there is no risk for liquidation because spot is not giving you additional capital. Are we following? Spot is not giving you additional capital to trade with, but futures is giving you additional capital to trade with. So if you trade and there's a loss, it's going to remove your money to cover up for that. So you have a tendency to lose all your monies while trading futures. So it's very important to use a stop loss order and to always keep in line with the volatility of the trading pair. So this is how you can calculate your profit and loss. Let's say we put our entry price at 0.10864. And our exit price at 0.1130. And we want to trade this with maybe 1,000 USDT. That means that we're trading on 10x. If your capital is $100 and you want to trade with 10x, that means your quantity would then be 1,000 US dollar. Please, did we get that calculation?
Yes.
Okay. If you're trading with $100, but you want to open a position size of $1,000, you don't have $1,000, you can use 10x so that the position size would then equal $1,000. And at this point, you can just click to calculate, and it's going to tell you that the initial money you are going to put in of your own money, that is margin, simply refers to your capital, your money that you're putting in. So I'm even happy that this is going through, even though there's no money on this account. So I actually don't need to revise this. So let's just continue. The initial margin here is $99.99 that you need of your own to open this $1,000 position. And the P&L, that is the profit and loss, the likely profit you are going to make on this trade with the entry and take profits that you've entered is $40. And your ROI, your return on entry, your ROE is approximately 40%. Okay, so if I want to reduce this now to, let's say, 5x, and I click to calculate, I want to reduce that to 5x. Okay, sorry, I forgot to adjust it. That means that my capital is $100, 5x is 100 times 5. That means I want to enter with 500 USDT, and I click to calculate. It is still giving me the same margin. My initial margin will still be $99.99. My profit will be $20 instead of $40. Are we getting it now? Even though it is the same capital I'm using, but the level of leverage is different. Okay, and the return on entry is just 20%. So you can see the difference when you adjust your leverage from 5x to 10x. Now, let's say I use 20x. I just want to use a final example. Today's trading is for futures, so we have to get used to this. That's why I'm repeating and repeating. Now, let's say I'm using how do I put it? 20x. My capital will be what? Will be 100 times 20, right? That will be $2,000 that I'm entering with. So I can click to calculate it, and my margin here will be $100. My profit would then be $80 as opposed to $20 if I use a 5x leverage. and my return on entry would be 80%. So you can calculate all of this to say, okay, let me use 20x, or okay, let me use 10x. But for the next part of this, we're going to be discussing risk management. If you check the table of contents, today we are discussing futures trading, best risk management for futures trading, how to prevent liquidation and all of that. That is what we're discussing today. So, but I want to even discuss how to place trades and calculate all of this before we move to the risk management aspect of the training. Now that you know how to place these trades, the next thing you need to know, you see all these things, all these PNL targets, prices, I don't bother myself with it. The only thing that I bother myself with is the PNL and the liquidation price. Okay, so the liquidation price, I click on it. Let's say I want to calculate the price in which my money will go if to say this if for example this trade is a losing trade and I want to calculate my liquidation price, I simply come here, click on liquidation price. Our entry price is what? 0.0. Where's our entry price? Can't find it again. Okay, 0.10864. 0.10864. That's our entry price. And the quantity, we said we are trading with 20x, so that will be $2,000. And I want to calculate my liquidation price. Okay, so it is telling me insufficient wallet balance. We cannot calculate liquidation price because there's no balance here. But anyways, if you click on this, it's going to calculate it and tell you the points in which your money is going to burn, where you're going to lose all your money. So in that regard, if you notice that your liquidation price is different from your stop loss, then you have to adjust your stop loss. We're already going into risk management gradually. If you notice that the liquidation price it gives you is different from your stop loss, then you have to adjust your stop loss. Now, if you keep adjusting your stop loss, you will not be able to stick to your strategy because your strategy states that you need to use a particular type of stop loss. So this is why I do not recommend anybody using anything higher than 10x leverage. If you use 20x leverage, if we did that calculation, I might, because of this particular aspect, use MEXC on our final day. But when you use 20x, you have a higher risk of liquidation, and it will even be far from where your stop loss is. So even when that trade might have yielded in profits, if you gave it enough room to move in your stop loss area, because you used a leverage that is too high, and because it has created a liquidation price that is above your stop loss, you might miss out on that trade. That is the risk of trading futures as different from sports. Okay, in sports, there's nothing like liquidation price or anything like that. And this is why most people that can master futures trading, they are always very, 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 very good with sports trading. Very, very good with sports trading. It's like starting with the hardest part, and then somebody now gives you, it's like you mastering 12 multiplication table 12, and then somebody is telling you to recite multiplication table 2. I mean, it's just going to be bonus for you. Okay, so if you can master futures trading, you'll be a very, very good sports trader. So liquidation, it's always best to use liquidation, not more, leverage, not more than 10x, in order to prevent liquidation and to give room for your stop loss to actually be in play. Okay. Now, for a beginner, I do not recommend you even use 10x. For your first set of trades, don't go and copy Diana and say, that trade that I saw that she did 400%, it was 20x that she used. The way I manage my risk is a little bit different. I've been trading for some years now, and I know how to manage these things. I know how to cut corners around it. So, but for a beginner, before you start mastering how to cut those corners around it, start with 5x leverage. 5x leverage. This is going to significantly reduce your loss and significantly reduce the possibility of you liquidating. And very, very important, do not for any reason forget to put in your stop loss. See, your stop loss is the most important one out of all the entry and whatsoever that we've discussed. Because what makes a successful trader is not his trading strategy, it is risk management. And we're going to go into risk management in the next 10 minutes. I just want to tell us the final thing that we need to pay attention to when we are trading futures. Okay, I've told you how to place the trades. I've told you, once you click these trades and all, you just click on enter and then the trade is set and go. Boom, it's in play. Your profits, once it hits the take profit targets, your profits will be taken and it will be right there in the exchange. If it hits your stop loss target, the trade is going to be cut short and then the remaining money is going to be left there. Now, the last thing I said I want to call our attention to when trading futures is this right here. Cross. If you click on this arrow, we have cross and we have isolated. Can we still hear me, please?
Yeah.
Okay. Now, I said if you click on this arrow here, we have cross and we have isolated. Always make sure. Anyway, it depends on you. But me, I've never, ever, for once, traded futures using cross. There are people that trade it and it works for them, but I personally use isolated. Now, let me tell you the difference between isolated perpetuals futures and cross perpetuals futures. Let me tell you what it means. You see, we have this arrow right here, the wallet, right? Now, before you can trade futures on any exchange, you have to first move your money from the spot market to here we have fiat and spot. I want to click on it so I can explain what it is that isolated and cross is all about. Okay, so I'm very rich. I have $0.19 here. As you can see, I don't think any of you even have up to these amounts. Anyways, let's continue. So this is our wallet. When you deposit money into Binance, this is where your money goes to. This aspect, fiat and sports. Let's say you want to start trading and you're like, oh, Diana, I want to start trading. Please, I need to buy USDT. And I tell you to send me your USDT address and you send it to me. Where you're going to find your whatever you bought, whether USDT or Bitcoin or whatsoever is here. What did I do? I simply clicked on wallets and clicked on fiat and sports. Now, before you can trade on futures has its own wallet separate from the fiat and sports wallet. Are we following? So if you want to trade on futures, you need to transfer your funds from fiat and sports to what? To your futures. Now, it's going to ask you which futures you want to trade, whether it is the coin own or the USDS. And we said we are trading USDS, right? So we click on USDS and then it's going to ask you which coin do you want to transfer or which crypto rather do you want to transfer. You type on USDT, you want to move your USDT and then you click on max and then you simply click on confirm and then it's going to transfer your money from the spot section to the futures section. Then you will now have money to trade futures. Are we following?
Yeah.
Now, once you've moved money from the spot section to the futures section to trade, the next thing you need to pay attention to or to be aware of is this isolated and cross that we're talking about. When you are trading and you use cross, let's say for this trade now, we said we want to trade $100, but we have moved $200 to our futures wallet. If you're trading isolated, you're telling it that that $100 that you've earmarked is all it should trade with. If you're using cross, you're telling it that it can continue, even if that trade is a loss, so it can continue to remove the money remaining in your futures wallet to fill up that position, to fill up those losses. Do we get the difference? I want to repeat it again. Once you transfer money from your spot wallet to your futures wallet, in your futures wallet, if you have more than the money you're using to trade, let's say you have $200 in your futures wallet and you have just $100 that you want to use to trade that particular one, but the total capital you have on that exchange is $200 and it is in your futures wallet. If you click on isolated, it is only going to use that $100 you have earmarked for that trade. But if you click on cross, it means that it is going to continue to remove from what is remaining in your futures wallet. So let's say that trade has entered a loss and you've lost your $100. It is going to remove from your futures, from what is remaining in that balance, to add to it, to cover up for what you've lost. But if that trade continues to enter a loss, that means that you're not going to lose just $100. You're going to lose the whole $200, because cross means that it can continue to remove money from your wallet apart from what you've assigned for that trade. So please pay very close attention to that. For any time you want to place a trade, if you pick a new trading pair, always check it, because these exchanges can be funny. They will expect you to be changing it on every trading pair. Okay, now I'm here on isolated, right? Because I've traded GRT on what's it called, Binance before. But you just wait. Let me go and look for another trading pair. I'm trying to click on it. I don't know why it's not clicking. This is the issue I used to have with Maxi web version to just be misbehaving. Okay, now it is clicking. Let's click on one very random trading pair. Let's click on AR. Excuse me. Now, what did he do? You saw that it has automatically changed this to cross, right? Did you notice that?
So
the exchange will always change it. In fact, the default will always be cross. So if you don't pay attention to it, for every trade you want to trade, ensure before you even enter entry price, ensure you change this cross, change it to isolated, and click on confirm. That is the best way, because if you mistakenly forget that very simple thing, it might cost you a whole lot of money, especially if you have loads of money in your futures wallet. It won't affect the money in your sports wallet. It will just affect the money in your futures wallet. So if you have $1,000 in your futures wallet and you want to trade with just $100, and you now go and forget to change from cross to isolated, all your $1,000 is going to use it. If that $100 should get liquidated, it will pick another $100 from your wallet to cover up. If that one gets liquidated, it will continue to pick it and pick it and pick it. So you have to always put that in mind, that whenever you're entering a trade, you have to ensure that that trade is on isolated and not on cross. Is that understood? Do you understand to that point?
Yeah.
Mr. Perry, I cannot hear you again. Are you still with us?
Yes.
Okay. All right. So that is that basically on how to place trades on futures. It's really that simple, nothing so special about it. I've told you how to place your price, your entry, your stop loss, your take profits, how to calculate your leverage, how to calculate your estimated profits, and also how to move your monies from sports to futures. Also understanding the difference between isolated cross margin, USDS perpetual contracts, and coin M perpetual contracts. We've done all of that. Now, let's move on to the next topic for this particular training, which is risk management. We have to discuss risk management before we call it a wrap today. And that risk management is very, very important. We are also still going to narrow it down. We are going to narrow it down. And once we narrow it down, we're also going to, we're going to narrow it down to futures trading in particular, okay? Because risk management general is there. We're going to jot some things on risk management for futures trading. Now, these things I want to give you, most other tutors would not tell you. In fact, if it's that I want to do it safe, I might just say, okay, join my advanced training class. It's $300, and then I'll tell you, I'll give you the secrets, because these small things, like for example, now just this isolated and cross is why some people lose money. They'll just become and see that all their money is wiped out for you because of just something as simple as that. So we need to discuss risk management and narrow it down to we're going to narrow it down, way down, to risk to futures trading and how we can have very profitable trades on futures. Okay, so let's get straight into it. For the purpose of this, I want to go back to our GRT USDT trading pair. I think it gives me room to draw. So we want to discuss risk management. Let me just get this out of the way. Okay, so we want to discuss risk management. Now, risk management simply refers to your contingency plan for your trade capital. When you're back testing, you will discover that through your back testing process, you might discover that the strategy in which you want to trade has a 70 to 30% or 80 to 20% winning percentage, which means that for every 100 trades, you're going to win that trade 70 times and possibly lose the trade 30 times. Now, I initially said in the beginning of this training that it is 70 to 30% does not mean that you will win one, lose one, win one, lose one, or you first win 70 before you now lose 30 trades. Sometimes you might first lose 30 trades before you win one trade. Crypto is that crazy. We have some traders that are in losses for months in a row, and they are still professional, profitable traders. Okay, so if your risk management is not tight enough to be able to accommodate the loss of the possible losses you might have in relation to your trading strategy, if you're supposed to trade 100 trades on that strategy to make a certain amount of profits, and then you don't manage your risk, in your second or third trade you've lost all your money, please, how would you enter the remaining 97 trades? So risk management has to be built down to, number one, your backtest results. Okay, what is the reward to risk ratio? How many trades do you want to enter? What profits do you want to make across those trades? And this is why most times those backtest results usually span a year. And technically speaking, statistically around the globe, to ascertain a profitable trader, you need to end up in profits after trading for a year. That is what we tell you. Oh, I'm a profitable trader. Oh, I need to learn. I'm still a learner. I need to learn more. Do you understand? So you need to have a full grasp of your risk management such that it can accommodate for whatsoever losses you encounter during the period of you trading that strategy. And we're going to discuss the three major cardinal points for risk management. I want to draw a triangle here. Mr. David is supposed to help me draw this triangle, but he will not help me. It's very wicked.
The chalk that I bought, they're just crumbling. That's why I couldn't.
I can see. It's very evident. Okay, so we want to draw. Let me see if I can just type. Oh, that's RM. So this is our risk management box. On top of it, we are going to have what I call maximum exposure. Maximum exposure. Let me increase this so that you can see it. We have maximum exposure. On this side, we have our risk capital. And on this side, we have our risk per trade. Okay, so we have our risk management box, and this is subdivided into three. We have the maximum exposure, we have the risk capital, we have the risk per trade. Now, this maximum exposure, people will define it in different ways for you, and how they use it in Forex might be slightly different to how we refer to it here in crypto. But let me just simply break it down since time is running out and it's not really on our side right now. Maximum exposure simply refers to, maximum exposure usually simply refers to how much you're willing to risk. Okay, now to make it easier for you, I want to start with risk capital. I think it will be easier for you to understand that way. Let's start with risk capital. Your risk capital is, let's say you have $20,000. Let's say you have $20,000 that you saved that $20,000. But you saw that this Diana girl, she's always posting profits minimum every 2 days. So you now want to trade like Diana. You now said you want to remove out of your $20,000 to trade. The next thing is to ascertain that $20,000, how much of it will not pain you if you lose that money. So let's say you are a nonchalant person, you don't care about the money because maybe you have one sugar daddy like Mr. David that will give you $50,000. Let's say Mr. David has promised you $60,000. So you don't care so much. Out of your $20,000, you are willing to lose, let's say, for example, you are willing to lose $10,000. That means you are willing to lose half of your saved money. That $10,000 that you want to use to trade, you said, okay, I'm removing $10,000. If I lose this money, my sugar daddy will dash me. So you now go and, or your sugar mommy, you now go and put your $10,000 and put it aside. That $10,000 then becomes your risk capital. The $10,000 becomes your risk capital. Now, after that risk capital, we have the maximum exposure. So you're trading with $10,000, right? That $10,000 as a professional crypto trader, no, not even crypto trader, as a professional trader, even if it is tomato that you are trading, as a professional trader, you at no point should your maximum exposure exceed 10%. Are we following? You see, this thing I'm saying, a lot of people just how do I put it? They hear it and just say, okay, I understand, okay. But it's a lie. All their life savings, they'll still go and put it and say, this thing is sure, it cannot flop. The person that recommended it is 100%, and then story will enter. You have put $10,000 as your risk capital. Your maximum exposure should not exceed, at any point, should not exceed 10%. What does that maximum exposure refer to? It simply means that even if you want to have 5 trades, because now we've traded just one, right? We have just one trade, which is GRT. Let's say I want to trade GRT and also trade this big because I saw head and shoulder pattern, and I also want to trade YGG because I saw double top pattern, By the time you look at all your loss percentage, it must not exceed 10%. Now, if you're trading $10,000, what is 10% of $10,000?
1,000.
You said what?
1,000.
$1,000. $1,000. So you're trading with $10,000. It means that your maximum exposure should not at any point in time exceed $1,000. You must not, for any reason, lose more than $1,000 on a trade. Okay. Now, that's $1,000 is on a trade. That means if you're trading only one trade. If you're going to enter 5 trades, you're going to divide that $1,000 into 5. And that tells you how much you can lose on a trade. So if you're going to enter 5 trades, you're going to divide your 1,000 by 5, which will give you $200. That means if you're entering 5 trades, trading with $10,000, you cannot afford to lose more than $200 on a single trade. Now, if you're trading it on futures and you see that the leverage you're using would cost you to lose more than $200, you must reduce that leverage. You cannot allow greed overcome you. Okay? Now, we are trading with $10,000. What's the first thing we need to do? The first thing we need to do is to look at our backtest results. Our backtest result has told us that this strategy is 70 to 30% winning ratio. Fine. On this 70 to 30% winning ratio, do I want to trade everything? Okay, that means that I have to enter trades on the GRT trading pair 100 times. So, for you to be able to enter 100 trades, if, for example, it's only GRT you want to trade, for you to be able to enter 100 trades with your $10,000 that means that you need to divide your 10,000 by 100, which will give us what?
20.
10,000 divided by 100 will give us $100.
Oh, yeah.
10,000 divided by 100 will give us $100. Are we following?
Yeah.
I'm telling you now how to use risk management professionally, not just as you like. You have $10,000 to trade. The first thing you need to do is look at your backtest results. What is the reward to risk ratio over how many trades? Fine. For you to be able to duplicate that in your live trades, you have to divide your risk capital by that amount. Okay. Now, some people, their maximum exposure may be different from their risk capital, but let's just continue. Now, your risk capital is $10,000. You want to enter 100 trades. That means that you can only enter each trade with $100. Can you see the way we're breaking it down now? Because some people who say they have $10,000, they've seen GRT, hey, double bottom, winning pattern. I'm going to put $5,000 there. Bam. No maximum exposure, no risk capital, no risk management whatsoever. Now, on $10,000, that means that for each of your trades, you have to enter with a maximum of $100 if you're trading with $10,000. Okay. Now, trading is not a get-rich-quick scheme. You need to understand that this is a process and you need to follow it if you really, really want to end up profitable. I've lost thousands of dollars. I can't begin to explain how much I've lost by not following this simple thing I'm explaining to you right now. You can say I'm not looking anywhere to say it. I'm telling you, explain everything from my head because I had to sink it into my soul before I started becoming a profitable trader. So don't joke with it. Now, you have $10,000 to trade with. Because of your backtest results, you're entering a trade with just $100. Now, on that $100, what is going to be your risk per trade? On that $100, what is going to be your risk per trade? This risk per trade simply refers to how much you're willing to risk per trade. So let's say as you've broken down and you've adjusted your risk management in line with your backtest results data, you've discovered that you can only enter a trade with $100. Okay. Now, what do you want to do with your $100? The same rule that applies to your maximum exposure applies to your risk capital, applies to your risk per trade, which is the 10% rule. At no point should you lose more than 10%. Cumulative. Okay, cumulative. So if you want to enter 10 trades, that means that day you're trading with $1,000 because you're using $100 per trade. That is $100, $100, $100 per trade. That's 10 trades, of which you will not see that particular pattern 10 times in a day. So I don't know where you want to see your 10 trades from that you're trading with $1,000. So now, let's say you've seen, let's say you've backtested this same pattern, or maybe 10 different trading pairs. That means you have a backtest results data of 1,000 trades. That is when you say, that's when you can say you want to enter 10 trades. Okay. Now, that's when you can say you want to enter 10 trades. Now, let's say you've divided your money into your $100. You now want to enter a trade. Let's say you want to enter 3 trades at a go. Your loss percentage should not exceed 10%. Your loss percentage should not exceed 10%. That means that for each trade, your maximum loss is going to be $10 because you're trading with $100. For you to be able to enter 100 trades on that trading pair, to be able to duplicate what is in your backtest results data, right? For you to be able to do that, you need to enter a trade with just $100, and the same 10% rule applies to it. On that one, you cannot afford to lose at any point more than $10. So you need to adjust your leverage to the extent that, and your position size to the extent that even when it hits stop loss, you are not losing more than $10 on that trade. That way, you know that when you enter 100 trades, you're making what? You're making $7,000 as profits because you are going to lose $3,000 if you are following your backtest results data. If your backtest result data, I told you that the backtest result data for these strategies we tested, the double top and double bottom, is 70-30. Tomorrow when we are discussing how to backtest and all, I'll show you the backtest, although I've backtested on different other, but I'm just going to give you one, okay? Because it took a lot of time. I don't just give that information out anyhow. So I spent over 2 weeks just backtesting this double top and double bottom on 1 hour time frame on just GRT alone. I spent 2 weeks on it. So I want to remind you again that trading requires work. When you see people post profits, don't envy or think maybe it's not achievable. They are showing you their results. They've not shown you the work that they put in for them to be able to achieve those kind of results. And I'm trying to remind you again that you have to put in that kind of work for you to be able to achieve those results, and have the discipline to stick to all these things we're teaching you. Because I'm not just teaching you based on I heard or I read. I'm teaching you this based on experience, basically, if you really want to become a profitable trader. So now I've told you that you must not lose more than 10% of your trade at any of your, you must not lose more than 10% of your risk capital at any given time. However, if you want to apply to a prop firms are those that allow you to trade for them. They can give you $2 million for you to trade for them, but they will first put you through a series of tests. If you're applying to a prop firm, your maximum drawdown refers to the loss percentage, which I refer to as 10%. Your maximum drawdown on a single trade must not exceed 5%. Can you see that? If you're training to trade for a prop firm, your maximum drawdown, which refers to your loss percentage, must not exceed 5% at any single time. So if you've not even trained yourself to master not losing more than 10%, how would you apply to trade for a prop firm? And trust me, trading with $10,000 and you make 70% reward to risk ratio over 100 trades, that means after 100 trades, your profit is $7,000. Compare that to somebody trading with $1 million because he's trading for a prop firm and they have the money to give him to trade for them. And then he's making $700,000 profit. So if you've not trained yourself to master risk management, I'm even being nice by saying 10%, prop firms will give you 5% maximum drawdown in any single trade. So when you hear that traders have liquidated their accounts, the first thing that comes to your mind is, did this person use risk management at all? Because you can't tell me you back tested your strategy and you adapted your risk management to your back tested strategy and you still liquidate. So the very first thing to do to prevent liquidation, let me type it too. The very first thing to do to prevent liquidation is number 1, always use stop loss. Number 2, ensure you utilize RM, which is risk management. Number 3, stick to duplicating your backtest results. Don't say because my backtest results, there was a trade that, when I saw during backtest, that trade, instead of 1.4 RR, that one went as high as 3 RR, 3 reward to risk. That means that I'm making times 3 of my capital. So you just feel like, this particular trade should give me times 3 now. And then you now just enter, without stop loss, without risk management, without understanding your leverage, without understanding your liquidation price, and now you should adjust your leverage and liquidation price to accommodate for your stop loss price, such that even at that, you're not losing more than 10% of your capital on a single trade. You see, if you cannot afford to stick to that, you're going to have significant, in fact, before you become a profitable trader, it will take you years. It's not a course. It's just fact. I was too stubborn too. I was like, hey, just, I don't have time. I don't have time to be doing all those back tests. I will just trade like that. I will join Signal Group. I will do this. I will do that. Nobody taught me. Nobody taught me. When I carried myself and my laptop and started back testing, when I saw how much I was losing. Because a signal service, a signal providing service, will only tell you when to enter and exit a trade. They're not going to teach you risk management. They're not going to tell you don't lose more than 10%. That's left to you. Mr. David, are you sleeping on us?
I'm with you.
We were hearing you snoring. Okay. Oh God, I can't stop laughing right. Anyway, let's continue. Let's continue. So a signal providing service is not going to tell you don't lose more than this money on a trade or keep this money on a trade or anything like that. You need to understand fully well how to use your risk management. Now, there is a particular thing also called dollar cost averaging. That's the last thing we need to discuss today before we call today's class a wrap. And dollar cost averaging is very effective for you to use when you're trading futures. So dollar cost averaging, also called for short DCA, dollar cost averaging. Let me type it so that's dollar cost averaging. Now, this dollar cost averaging was developed by economists, which stipulates that at least to enter a trade or to place any trading pair, you should split your capital in such a way that you're splitting it into 10%. Okay. Now, let me explain what that means. We already said that for each of your trade, if you're trading with $10,000, each of your trade should not be more than $100 for your position size, right? Now, for that position size, remember that not all trades will yield in profit. Some will give you losses. So let's say that you want to enter that trade. Now, this dollar cost averaging is the most effective way to manage risk when trading futures. Because what it means is that, let's say you want to enter a futures trade. You do not enter with your whole $100. Okay? You can divide that into 3 parts or 4 parts. If you divide $100 into 4 parts, you first enter with $25. Now, when you enter with $25 and you see that your liquidation price is close, or you see that the price has dropped a bit, you can then add another $25. What it does is that it gives you room to make more profits because you are reducing your entry points. Are we following? Now, let me use this our example. This our trade as an example so that we can finally wrap up for today. Let me use this our trade as an example. Or let me even just place the 2 so that I won't waste our time. Let me just place the 2 somewhere around here. Now, let us say that we entered this trade. Let us say that we entered this trade. We entered this trade at this point. Can we see my screen, please? Can we see my screen? Mr. Perry, are you there? Anyways, let's just continue. I guess he's having network issues. Let's say you entered this trade at this point. Yeah. If you have $100 to enter the trade, you're not supposed to enter the trade with the whole $100. You can start by splitting that capital into 4 parts. That means that you enter with $25 at first. Mr. David, please. Maybe you should mute your microphone. Thank you. Now, you can enter with $25, and then once you enter with $25, when you see that price has dropped to this point, once you see price has dropped to this point, you can then enter again with that $25. What it does is that it reduces your entry point. So the profit you're going to make from here to here will be different from the kind of profit you will make from your initial entry to that point. So instead of you becoming frantic that this trade is getting close to my stop loss, what you can simply do is to just add more margin, that is, add more capital. What you can do is to add more capital, that is, add more margin. So if I want to repeat that again. If you're entering a trade with $100, I said dollar cost averaging stipulates that you can split your capital into as many parts, if to up to 10%. Okay, so if you have $100 to enter a trade, you can split it to as much as 10 parts. You can even split it to 5 parts. So don't just out of greed say, if this $100, this is how much this $100 will make me. If so. You can first enter the trade with $25. If that trade goes according to your plan, all well and good, you've made profit. But if you now say that you want to enter with your whole $100, when price gets to this point, you're going to start panicking because it's already getting close to your stop loss. So the best way to not to give yourself high blood pressure when you're trading is do not enter with the particular capital for that trade. The risk per trade, not enter with all that capital. Split it. You can enter with $25 in your entry. Then once price drops, you can add maybe $50. You can double it. It will automatically drop down your entry significantly. And once it drops down your entry, it means that by the time the price even goes back to that entry from where it drops to, you're already in profit. So if the price now continues to go up, then you make much more profit than where your initial entry is. So you can see the difference between a professional trader and just a regular trader. A regular trader will enter with all his trade capital. A professional trader will split that trade capital into parts because price fluctuates. It will fluctuate up and down. So when it is fluctuating down, you enter again with a higher capital than your entry point. So let's say you entered with $25. Your second entry can be $30. Once you see price has dropped and you're already in minus, maybe minus $10 or so, you can add more margin. When you add a whole $35 to minus something, it is going to automatically go back to maybe profits. It will significantly reduce your entry points. So by the time price goes back to where you initially entered from, you might already even be on 20% profit already. And then once the price then continues to go up, you certainly make your profit. So that is how to use risk management specifically for trading futures, because futures is very fast paced. So you need to be able to make those decisions quickly and do not let greed I don't know why I keep mistakenly I don't know why I keep clicking that one. I wanted to click on Binance. So do not let greed take a hold of you to the extent that you just place trades randomly without using risk management or anything like that. Please always ensure that you use proper risk management. So at this point, I want to ask us if we have any questions. Do we have any questions, please? Are we here?
What do you call the formula of DCA the other time?
Let me go back to where dollar cost averaging. Let me go back to this place so that you can see the screen. I think maybe your network went off because I was calling
Yes,
you.
we're
I
going
didn't
off
hear.
and on.
Okay. So this is
It
what
was
we
going
have
off and
here.
on. Okay.
We have the dollar cost averaging. And we have our
Okay.
risk management triangle. So tomorrow we're going to be moving into back testing and how to use a proper professional spreadsheet to back test
Okay.
your trades and all of that. All right. So at this point, I want to thank everybody that joined us. Do we have any observation, comments, addition, or questions? Are we here?
Yes, we're here.
Okay.